competent provider. The financial services industry is no different in this respect from other services like car mechanics, doctors, and lawyers. The bottom line is that only you know when you feel comfortable with a financial services firm and the person handling your account. Richard Ferry is a chartered financial analyst and the founder of Portfolio Solutions, an investment managing firm with something like $1 billion in assets. He's written at least 6 books about investing and writes for Forbes, among other media appearances. He offers a 3-point approach to choosing a financial advisor. First, know what you want. You wouldn't go into a car dealership and say, "I need a car, any kind will do." No, you might not know exactly what you want, but you know whether you want a truck or a car, a big car or a small one, a convertible or a sedan, and so forth. For a financial advisor, the first question might be, are you looking for a big picture advisor or do you want a portfolio manager? The term financial advisor covers 2 types of skill sets. Financial planners are generalists. They're the big picture guys who help with budgeting, insurance, taxes, and estate planning, as well as investing. The other type of advisor is the portfolio manager. These guys can help sketch out a plan, but their specialty is managing money. That is, investing your assets and handling trading activities according to your investment strategy. Financial planners usually hold either of 2 certificates. They might be a CFP for Certified Financial Planner, or perhaps a CHFC for Chartered Financial Consultant. These certificates require about a year of classwork plus experience in the field. Portfolio managers and investment analysts more commonly are CFAs, or Chartered Financial Analysts. Think of a CFA as the investing equivalent to the accounting profession's CPA, or Certified Public Accountant. Anyone who holds any of these 3 credentials is bound by a code of ethics. These certifications and codes of ethics are that layer of industry protection we mentioned earlier. I'd also check to see if the advisor has fiduciary responsibilities. That means that the advisor has to put his client's welfare ahead of his own, and they must disclose conflicts of interest. That doesn't guarantee that the advisor will put your interest ahead of his own, but if he doesn't do it, then he'll face more severe penalties than he would without fiduciary duties. The SEC and state securities agencies keep records on financial advisors. You can always check to see if the advisor has a clean record. Keep 2 things in mind, though. First, a clean record doesn't mean the person is honest. It means nobody's complained yet. Second, an SEC complaint is a little like an NCAA recruiting violation. Some of them can be serious, like fixing an athlete's grades. Some of them are just ridiculous, though, like bumping into a recruit 100 miles from his hometown and saying hello outside of the designated recruiting period. The advisor's record is important, but it's just one bit of information that can help you make your decision. Richard Ferry's second point in selecting a financial advisor is to find someone who shares your investment philosophy. If you think that markets are pretty efficient and want a passive strategy, then choosing an advisor who thinks he can pick winners on a regular basis just can't work for you. He'll always be recommending stocks to buy and sell, and you're not going to want to hear it. Some investors want an active strategy because they think that an advisor can pick winners. If you think you can find a guy who can do that, then you're going to expect more stock recommendations and account activity. An advisor who leans toward buying a diversified portfolio and more or less sitting on it won't suit your needs. It can be hard to tell whether a broker's advice is in your best interest or whether it's just designed to generate a commission. That brings us to Ferry's third point. Find out how your broker gets paid. If you know how a person gets paid, then you know a good part of what determines his behavior. Advisors mostly get paid in 4 ways. None of them is perfect. First, they may collect commissions, which are fees paid to salespeople for